It was only back in early December that I was talking about PayPal stock as a potential compounder and a stock that I was keeping an eye on in case it dropped to value territory. Now, after weaker than expected Q4 results and weaker than expected 2022 guidance, the stock price has dropped to around $119 per share, a number I definitely thought we wouldn't see again, at least unless something dramatic happened. And you can see here, just after they reported results, the stock dropped 32%, almost overnight. So the market really hasn't taken this well. And the question that we need to be asking ourselves, and what I'm asking myself now, is should we be taking advantage of this 32% drop? And in this video, we're really going to be focusing on the Q4 results themselves, guidance, PayPal's competitive positioning, and essentially reassessing the stock and the business in a bit more detail and deciding whether $119 per share, PayPal does possess a good investment opportunity going forward. And we'll start with the bad, and that essentially is the mediocre Q4 results. You can see the summary here. Revenue for the quarter, year over year, 13% growth. This is including the eBay fallout that we spoke about in the last video I did for PayPal. But 13% growth year over year really isn't very interesting to a lot of investors when they're having to pay 35 times earnings per share. So 13% underlying growth with a 35 times multiple really doesn't make a lot of mathematical sense and doesn't equal a good estimated return. Now, excluding eBay and that fallout, the growth rate was 22% year over year, which isn't bad, but still what we're seeing here is a trend down in the growth rate. You can see TPV trends here. Q4 2020 would have been a very good space in time for the company given COVID and all of the necessities around digital payments, but we're now seeing a trend just slow down slightly. So the latest TPV growth rate in this quarter was 23% year over year and 27% excluding eBay. Take rates are also going down because of this eBay fallout, so revenue is hit even harder. And the reason why is because all of the marketplace TPV from eBay is at a 3% take rate versus the average of 2% or just under 2% on all of the other platforms. So it is one of its highest yielding customers. So revenues hit even more so, 13% year over year growth versus 23% in Q4 2020. But all in all, I think this is quite normal. This isn't just PayPal. We've seen this with a lot of the big tech companies where they had this real spike in growth through the pandemic and they were seen as a lot of the thrivers of the pandemic. Inevitably, on a year-over-year basis, that growth is going to slow down as we come out of this COVID period, and it will normalize a little bit. We've also got to factor in the size. PayPal is now doing 25 to 30 billion in annual revenue, and its TPV is up in the trillions. So there's only so much more these businesses can do in terms of growth unless they really redirect their business. Now, the other thing as well that has probably sparked a lot of worries with investors and definitely something that I'm looking at closer with PayPal. Competition is heating up and potentially is PayPal losing market share to other payment companies. And if you look at the quarterly results across some comparable companies, people who compete for customers with PayPal and compete with merchants, we can see that the likes of Adyen, who eBay replaced PayPal with, grew at 72% year over year in terms of their process volume. And then Wise as well, which is more of a cross-border payments company that beats PayPal on fees and things like that, that grew at 38% year over year in their most recent quarter. So PayPal among this peer group, was the slowest in terms of year over year growth, which indicates to us that they lost some market share. And when we look at cross-border transactions in a bit more detail, and remember, this is something that was really a value add for PayPal back in the day, or not even back in the day, a few years ago. Cross-border transactions using PayPal, they were one of the only companies that you could use for it. If we look at MasterCard's most recent results, we can see that cross-border volume, and MasterCard obviously being a payment gateway, does sort of encompass the whole industry, them and Visa to an extent, and Visa posted very similar numbers, so I'm just putting MasterCard here for simplification and because of lack of room on the page, but 53% year-over-year growth in cross-border transactions in the quarter. PayPal only saw 5% growth year-over-year, and their share of total revenue or total TPV on cross-border transactions is going down quarter over quarter. Remember, this is another part of PayPal's business that was a higher take rate in terms of their TPV. So definitely a negative and something that investors will be looking at and saying, is their competitive position worsening Is their moat increasing? Because everything that you used to think about with PayPal is it's a highly competitive advantaged business on the supply and demand side. But these most recent quarterly results, if we look at the entire industry, do start to beg to differ. Now, this is only one quarter. We will just obviously beat that drum. This doesn't mean that the story's changed completely, but it's an indication that maybe the competitive positioning isn't as strong as it once was or as it has been in the past. Now, guidance in terms of looking forward, another reason why the stock sold off aggressively is it didn't meet valuation expectations. And what I mean by that is if they're guiding for mid-teens growth year over year and saying that, look, we're not expecting to add that many new users in the future, meaning that the growth lever we're going to have to rely on and pull is engagement. So focusing on raising average revenue per user with the users that we have. This isn't a major issue. This is what we see with a lot of big tech companies once they get to a stage of maturity in what they have. And remember, they have over 400 million active accounts. So they are in a mature state. I do think they can add net new active users, but they will need to focus on monetizing those users. And we'll get into what they need to do for that in a moment. But didn't meet expectations, like 6 billion of free cash flow next year. That was 36 times forward free cash flow in terms of where the price was. It was at, I think, 220 billion as a market cap before the stock price dropped. So not amazing value if we're talking about teens growth. And now off the back of the sell-off, PayPal is now 23 times forward free cash flow. So that's 6 billion. The current valuation is currently 23 times that, which is better, don't get me wrong, but it does depend on the 3 to 5 year growth rate, not just next year's growth rate. And if we're looking at a trend going down, 23 times forward free cash flow when yields are rising and things like that isn't that attractive. And obviously, just to make matters worse, a lot of investors or a lot of people that I've spoken to about it have referenced the fact that it was only a year ago that management put out guidance saying that they expect 20% CAGR growth up until 2025, getting to 50 billion in revenue by that point, and also expanding their margins. Now, just 1 year later, they are reducing those expectations. But in all fairness to management, what I will say is if we look at the growth excluding eBay and the move that eBay made in terms of coming away from PayPal, they are still on track for that 20% CAGR, just so long as they don't continue to see a downtrend. And so I guess the other side to this, and what I would like to stress as well in terms of my opinion on PayPal, is I wouldn't count PayPal out just yet. Obviously, I said earlier that this is only one quarter's results, and that's very important to consider. Sometimes the market can overreact to what they see as a momentum shift, but it could just be a blip in their business. I don't know. I'm just saying to keep that in mind. And when we look at some of the qualitative factors, so not necessarily in the numbers yet, we can see that, look, the likes of PayPal, they're adding in all of these merchants, large corporate merchants as well, the likes of DoorDash, Instacart, Roku, Gap, Adobe, Oracle, Salesforce integrating into their systems, and Amazon as well starting this year, enabling customers to check out with Venmo, which will come at some take rate to PayPal. So they are going to be monetizing this. And this is all examples of how PayPal really can leverage those 426 million active accounts, right? Still increasing as well, and number of transactions up at 5.3 billion. Those are numbers that really allow you to have supply side leverage with these large corporate sellers, and still sort of hints at the fact that PayPal does have some network effects still at play here, even though it's got to this stage of maturity. So the point here is that if we look beyond just the numbers at the moment, the business is still progressing in some ways and still does have ways in which it can grow its business. And so what does the next 5 to 7 years look like for PayPal potentially? We have got these 426 million active accounts. We've got obviously engagement increasing as well. Like I said earlier in this, net new accounts will almost definitely slow. We can see that trend happening before our eyes, and I don't think that's going to revert anytime soon. So PayPal are having to focus on engagement and raising the average revenue per user, which I think they can do, by the way. All of this stuff in the slide before will help with that. And what we need to highlight, I know we've highlighted it briefly, but underlying growth of the business, excluding eBay, was still north of 20% and expected to be 20% in 2022, as they gave in their guidance. This could potentially signal a re-acceleration of TPV and revenue after the first half of 2022, which will no doubt be good for the stock, and the street will almost certainly take it well. But important to note that the flip side to this, like I said earlier, is that margins will likely come under pressure and reduce somewhat with the eBay fallout, just because that was the highest take rate customer at 3%. The rest was just below 2%. And unless there's a lot of expenses that goes into the eBay deals, which I don't think there is because it's their longest standing one, margins will come under pressure a little bit from that. And if competition also forces PayPal, into lowering fees to retain some market share, we've seen the likes of Adyen, the likes of Wise, and many other companies as well, stealing market share in the cross-border transactions realm, and also just in digital transactions in general. So margin could come under pressure if they need to lower fees, but I think they have the room to do that and maybe able to offset it in some operating leverage, at least from what I've seen in the past. Now, an additional thing to think about is Venmo, right? Continuing to monetize from essentially 0% to whatever percent it can get to. 1% would even be great considering how many customers it has. That will have a material effect on not just take rate, but most likely go directly to the bottom line in terms of its incremental margin, just because they already have, or they're already running with all the expenses of Venmo. It's just now that they're beginning to monetize it with getting it into merchants' hands and allowing people to check out using it, not just using it as peer-to-peer payments. So all in all, it's likely that PayPal's growth will reduce, in my opinion, to mid-teens over the medium to long term, unless there is a redirection or change in their business, and we may see some margin pressure. So what does that look like in valuation terms is the next thing that we want to look at. I had a valuation previously on PayPal, making some adjustments to it. Those adjustments that I just spoke about, if we go to mid-teens growth rate instead of the, say, 18 to 20% that I had looked at before, and we reduce operating income margins to around 15%, there is very strong cash conversion, so that actually gets us to around 19 to 20% on a free cash flow margin basis, which is just below where they are today. And if we reference it against guidance from management back in 2021, they hit 45 billion of revenue by 2025 instead of the 50 billion that they set out. And you can see it doesn't look amazing if we go with these estimates. It gives us an intrinsic value based off a 15% discount rate of around $96 per share. What I will show you is if we make some adjustments to that, if they manage on judgment day, let's say in 2026, to get some of that eBay take rate back in terms of putting it into their main business, able to monetize the likes of Venmo to a full extent, then we might see 20% operating margins with similarly strong cash conversion at around 25%. In that case, then the stock is sitting around its intrinsic value. Not a huge amount of upside, but sitting around its intrinsic value. All in all, you are looking at obviously a fluctuating DCF model, and this is obviously the weakness of a DCF model in that the fair value changes based on the inputs that you put in, and you can play around with the inputs to quite a large extent and get a significantly different intrinsic value. So that is the issue with it, and it's subjective depending on, do you think PayPal will re-accelerate if we think about the underlying growth with eBay, let's say 20%, will it be able to retain that 20% going into the next 4 to 5 years? Management seem fairly confident that they can keep in the high teens to 20% once they get past this headwind. And if they do that, then you're looking at a stock that has over 25% upside based off of a higher rate of return. So looks like it could be a decent buy. But for me, I would like to, just based off what we've seen this quarter, lean on the side of conservatism and think about protecting my downside with PayPal. And it's not necessarily that I think you'd lose money with PayPal. I think it's highly unlikely you'd lose money with PayPal. After all, they are still an amazing business. It's one of the best businesses in the world. It's just that they've reached quite a mature state. Growth is indicating that it could be trending downwards slightly. So it's more an investment return risk. And obviously on this channel, we're looking at companies or stocks that can compound at high rates of return with a fairly significant margin of safety. But in summary, I'll say this is probably the bear case at the moment for PayPal. I don't want to focus too much on the most recent quarter. That's just what we can dissect at the moment. That's the data and information that we have and we have to analyze. I'll be looking into it a little bit deeper and just assessing whether these forecasts here are true and whether actually I feel there is more upside than this model is letting on to. I just really wanted to come on here and give my instant thoughts based off of the quick drop and the Q4 results, and also maybe talk about why I haven't jumped into buying PayPal off the back of my last video on it, where I said it was a business I would like to own, and it's just dependent on price. So that's going to be all for this video, guys. Thank you for watching. I will leave a link to the Patreon in the description, where you can get a copy of this valuation model, the IRR, and all the other companies that we cover here on the channel. You'll also get access to my deep dive write-ups that I'm doing each month at the moment. We did one on Mercado Libre previously, 6,500 words. We've got one on Spotify coming out this month very soon as well, and then we're covering other stocks just here and there in terms of exclusive analysis. You'll also get access to the Discord community and all of the investors on there, and companies like PayPal are in discussion every single day. So go and check that out if you're interested. I'll leave a link below. Apart from that, thank you all for watching. I'll see you in the next one. Good luck with your investments.